Let's think about a company's finances, like a high-wire act. Seriously. On one side, you've got pure ownership. That's equity. And on the other, you have borrowed money. That's debt. The balancing act between those two, it's one of the most critical things in business. And today, we're going to see how one of the biggest companies in the world walks this exact tightrope. Take a good long look at this number, $279 billion. This isn't the budget of a small country. As of early 2024, this was the total debt of one of the most famous, most valuable companies on the planet, Apple.
When you see a number that huge, you've got to wonder, right? Is Apple teetering on the edge of a cliff, about to get buried under a mountain of debt? Or is this massive number actually a sign of incredible financial strength? A super smart move to use cheap money to grow the business and pay back shareholders? Well, that is the billion-dollar question we're going to answer.
So how in the world do we even start to answer that question? I mean, we can't just look at the debt by itself. We need a tool, a specific tool that all the financial pros use to really see what's going on with a company's health.
And that tool, lucky for us, is called the debt-to-equity ratio, or as you'll usually hear it, the DE ratio. This one simple metric is the absolute key to understanding how a company is paying for everything it does and just how much risk it's taking on.
So, let's get into the nitty-gritty. How is this ratio actually calculated? We're going to break it all down, and I promise it's way more straightforward than it sounds.
At its heart, the DE ratio is all about something called financial leverage. It's just a straight-up comparison of how much money a company has borrowed versus how much it's funded with its own capital, the shareholders' money.
And the formula itself? Super simple. You just take the company's total liabilities, that's all its debt, short-term and long-term, and you divide it by its shareholder equity. And the best part is, you can find both of these numbers right on a company's balance sheet. Okay, so let's plug in the numbers for Apple from their report in the first quarter of 2024. We've got total liabilities sitting at $279 billion, and shareholder equity is at $74 billion.
You run the math, and boom, you get this, 3.77. So what does that mean? It means for every $1 of its own money, Apple has borrowed $3.77. Now, the crucial point is, what does that number actually tell us?
So we have our number, 3.77.
What does it really mean?
Well, understanding this ratio is a real balancing act. It reveals a ton about a company's strategy and how much risk it's willing to take on. This one little number gives us a snapshot of three really important things. How much a company relies on debt, that's its financial leverage, the potential risk for anyone investing in it, and its big picture strategy for how it's going to fund its own growth.
Okay, so the general rule of thumb is this. A higher D/E ratio usually means higher risk. And it makes sense why, right? A company with a ton of debt has to make those interest payments no matter what. So if profits suddenly take a nosedive, those debt payments can become a really heavy weight. But here's the thing. Debt isn't always the bad guy. It's really a double-edged sword. On one hand, borrowing money can totally supercharge a company's growth. It lets them expand and boost profits. But on the other hand, that debt always has a price tag, interest payments that can chip away at those very same profits. Now, this is where it gets nuanced. A DE ratio of 3.77 might sound kind of high, right? But we can't just judge it in a vacuum, because when it comes to these ratios, context is absolutely everything.
Which, of course, brings us to the million-dollar question. So what is a good D/E ratio? And the answer, which might surprise you, is, well, it depends. It almost entirely depends on the industry you're looking at. Just look at this. It shows you exactly why context matters so much. For a business like a utility company, which has really stable, predictable income, a high DE ratio is completely normal. No big deal. They can borrow tons of money and cheaply. Now look at Apple's 3.77. It's high, yeah, but it's not crazy for a super successful tech company. The single most important thing is you have to compare a company's ratio to its direct competitors.
And check this out, here's the really counterintuitive part. A DE ratio that's too low might actually be a red flag. It could mean the company's being way too cautious, and it's missing out on chances to use debt to grow and make more money for its investors.
But wait, there's more. To really read between the lines, the savviest analysts don't just stop there. They actually tweak the ratio to get an even clearer picture, peeling back another layer to see what kind of debt a company is holding.
And that brings us to the long-term DE ratio. See, instead of looking at
all the liabilities, this version only looks at debt that's due in more than a year. And the reason is simple. Long-term debt is often seen as the riskier kind. It's subject to changing interest rates, and paying it back depends on the company being successful way down the road, which is always a little uncertain.
Okay, so this is all great for massive corporations. But what does any of this mean for you? Well, this whole idea of a D/E ratio, it's not just for Wall Street. It's a principle that applies directly to our own financial lives.
Think about it. When you go to apply for a big loan, like a mortgage, the lender is basically calculating your own personal debt-to-equity ratio. They're comparing what you owe to what you own to figure out how well you can handle those payments, especially if your income suddenly changes. All right, let's boil this all down. What are the big takeaways? First, the DE ratio is all about measuring financial leverage, debt versus equity. Second, a good ratio is all about context. You absolutely have to compare to others in the same industry. And finally, always remember, debt can be an amazing tool for growth, but it always comes with risk.
At the end of the day, whether we're talking about multi-billion-dollar companies or just our own personal finances, the story is pretty much the same. Debt can be a powerful tool that builds wealth, or it can be a really dangerous trap. The key is knowing how to find the right balance. So I'll leave you with this. Knowing what you know now, how would you use it?